Hi, and welcome to this week's market presentation.
Latest news.
Starting in Europe, EU ministers agreed to a 90% emissions reduction target by 2040 from 1990 levels. The deal will include additional flexibility measures, such as allowing up to 5% of foreign carbon credits to cover domestic emissions, reducing pressure on the European carbon market. Additionally, the ETS2 launch will be delayed by 1 year to 2028 in exchange of their backing for the EU's 2040 climate targets. Additionally, talks are scheduled for the UK to discuss the linking of the EU and UK European trading schemes. The impact on markets and energy prices was quickly felt by an initial decline in carbon prices given the policy's greater flexibility measures, although the longer-term bullish sentiment and trend in carbon prices remains intact with continued expectations of tighter supply and demand conditions moving forward. The 1 year delay in the ETS2 has created a slight bullish price impact by reducing supply timeline pressure. Lastly, the fact that the deal will allow for foreign credit allowances is expected to reduce pressure on the European Union's trading scheme and the ETS2 domestic markets. Moving on to North America, the US federal government shutdown has now become the longest in US history, with federal workers now experiencing multiple missed paychecks and significant chaos onto the US population, with several key aid and welfare programs having lost funding. A breakthrough with the deal in principle to reopen the government was agreed upon this week, with the expectation that by the end of this week or early next week, a vote to reopen the government could be accomplished, ending the current uncertainty and chaos in the US. The main impacts of the shutdown on energy and financial markets has been the lack of key economic indicators being reported and published on, adding additional uncertainty and a lack of visibility on economic conditions in the US. Certainly, if the current deal to reopen the government was to fall through, we could see the shutdown extended further, which could further add a pessimistic sentiment to financial markets, worsening the economic outlook for the US. And lastly, following Hungarian President Orban's visit to the US with President Trump, Hungary appeared to secure an exception to the oil and energy sanctions that the US had introduced against Russia. More importantly, Hungary obtained a 1-year exception for Turkstream and Druzhba pipeline imports, which was a key source of oil and gas for Hungary. The exception was justified based on Hungary's landlocked geographic challenges, although many analysts also indicate the closer relationship between President Orban and President Trump. This decision by the US will certainly create tensions within EU partners over Russian energy dependence. The impact on markets was most noticeably felt in the Hungarian market, with the exception likely to momentarily reduce the supply pressure for Hungary and have the knock-on effect on Hungarian energy prices. On a global scale, the impact of the sanctions could certainly be bullish, particularly if we see China and India complying with them.
Weather.
Moving on to the weather forecast, temperatures across most of Europe are forecasted to be above the seasonal average throughout the beginning and middle of this week. However, as we look to the beginning of the following week, colder temperatures will start sweeping particularly over Northern Europe and see temperatures across most of Central and Western Europe move closer to the seasonal average. Precipitation is also forecasted to pick up, especially in the second half of this week and early next week across Europe. Lastly, looking at average wind speeds, we do see a slight improvement through the beginning of the week. However, looking further out, wind speeds are expected to remain on the lower end, keeping a lid on wind power generation across the continent.
Macroeconomics.
The latest PMI figures for the US were released for the month of October. We showed a relatively stable picture with both the manufacturing and services sector remaining in line with September's figures, with both remaining above the 50-point level. In terms of inflation, Chinese inflation figures for the month of October were also released, and it showed a slight increase in both the year-over-year inflation rate and the core inflation rate. However, we continue to see the Chinese economy facing de-inflationary pressures as it has been doing really for the last couple of years.
Crude oil and LPG.
Crude oil prices saw a decrease over the past week, with both WTI and Brent crude oil prices decreasing roughly 1.7% week over week in what has more clearly been a bearish price evolution, especially for the front month product. Overall, crude oil prices continue to face downward pressure from the lower demand expectations for the coming year, in part driven by the ongoing trade tensions globally, with the US tariffs still being in place. And on the supply side, very importantly, due to the oversupplied expectations as OPEC Plus has continued to increase production quotas aggressively throughout the year.
Natural gas.
Looking at natural gas prices, we see a pretty stable price evolution over the past week, with pricing seeing quite limited movement both in the short term and further along the curve. Looking at European storage levels, we see a slight decrease in storage levels over the last few days, with overall storage levels across Europe remaining steady at around 82%. Gas storage levels remain roughly 12% lower year on year, in one of the bullish factors in the market. Looking at the injection and withdrawal rate, we see the net withdrawals over the past week, which was a slightly later start to what could be the beginning of the withdrawal season compared to last year and the average since 2012, although still slightly earlier than we saw in 2022 and 2023. Looking at total supply and demand, we note the increase in total demand very much weather driven, with colder weather in Europe increasing heating consumption across the continent. Nonetheless, total demand remains below last year's levels and, importantly, below the past 5-year average. On the supply side of things, we continue to see a gradual improvement in the supply outlook for Europe, although not increasing as quickly and as fast as demand. Looking at the European gas supply mix, we see Norwegian gas flow seeing a further increase over the past week, pushing up slightly above last year's levels. Looking then at LNG sendouts, again, the second largest source of natural gas into Europe, we see an increase over the past week to accommodate the increases in total demand in Europe. Looking at LNG imports next, we see that continued increase in the share of global exports going to Europe, with very strong LNG supply into Europe, helping add some downward pressure on prices. Importantly, for global exports, Canada's LNG terminal in British Columbia started production at its second liquefaction train, adding a further 9 billion cubic meters per year of export capacity. Looking at investment fund positions here, we note the more bearish sentiment that is currently driving investment positions over the past week, with a further decrease in the level of net long positions, as we saw a slight decrease in long positions and a further increase in short positions in the market. Overall, mild weather forecasts are reducing heating demand expectations, keeping that lid on prices as well.
Coal.
Looking at coal markets next, we see a slight increase, particularly looking at the API4 and the Newcastle coal indices. And overall, we've seen a noticeable increase in the price level over the previous month. Nonetheless, we still appreciate a neutral price evolution when it comes to coal prices, in large part driven by the above average temperatures, limiting overall heating demand in Europe, the still satisfactory levels for renewable output, further reducing demand for fossil fuels, and very importantly, the higher carbon prices and relatively more moderate gas prices, resulting in additional coal to gas switching.
EU and UK emission allowances.
Looking at the emission allowances, we saw carbon prices in Europe increase by around 2.1% for the spot market and 1.2% for December 25 product, in what remains an overall bullish price evolution. Looking at the opportunity hunting percentiles, we do note the spot market at the 81st percentile, showing prices being closer to historical highs looking backwards. On the UK side of things, there was a slight price reduction over the past week, with prices decreasing by 1.5%, but nonetheless staying at relatively high levels compared to where we've been over the past year. Looking at emissions, we've seen that uptick in emissions over the past week, in particularly largely driven by the decrease in renewable power output in Europe and the corresponding need to increase fossil fuel power generation. In terms of investment fund positions, we continue to see record high long positions in the market as market participants remain bullish when it comes to carbon prices in Europe, primarily driven by tighter expectations in terms of European allowances supplies starting in 2026. Nonetheless, the weather forecasts remain more favorable, and lower gas and higher coal prices certainly leading to that additional coal to gas switching and reduced emissions from the power sector, keeping that upward pressure in the market somewhat more muted. Taking a closer look at the European Union's climate targets for 2040, what we'll see in the remainder of this year is for the Council to agree on the 2040 targets, as well as to agree on that political commitment to postpone the ETS2. In the first half of 2026, we'll see the European Council and Parliament continue the negotiations on fine-tuning the legislative language, with the expectation that there will be a formal adoption of the targets by late 2026, with implementation of the measures starting in 2027 and potentially dragging through 2028.
Electricity.
Lastly, looking at electricity prices, we saw a slight uptick in power prices in Germany, with prices increasing around close to 2% for the year ahead. Overall, we note a more bullish price evolution for electricity prices along the curve, with prices now upwards of 7 to 10% higher than 3 months ago. The price evolution we see in Germany was similar to that in other European countries, particularly looking at Poland and Italy, as well as in Denmark. In other parts of Europe, particularly looking at the Iberian Peninsula, we saw a slightly more stable price evolution over the last few weeks. And then we do have an outlier in France, which has seen additional bearish pressure on the market due to oversupplied expectations in France, leading to those low prices for the year ahead. Over in the Nordic region, we were seeing the wetter weather forecast add more bearish pressure to the market, with a slight uptick over the past week. In terms of residual load, we saw an uptick in residual load over the past week, very much driven by the drop in wind power generation, as we'll see in a few slides. In terms of total grid demand, that has remained relatively stable near the lower end of the range over the past 5 years. Starting with French nuclear generation, in terms of the European supply mix, we see that nice improvement over the past week, pushing output to the highest levels over the past 5 years, with output in the month of October reaching a 4-year high. Looking forward, we do see some uncertainty with the potential for a reduction in output in the coming week due to some outages at several reactors. However, the overall outlook for the coming months remains positive. Looking at renewable power generation, we see that drop in output very much driven by that decrease in wind power generation, which then led to a corresponding increase in fossil generation to make up for the difference. As we see here, wind output went from a record high for this time of year down to just above the past 5-year average. Solar power generation saw a slight improvement week over week, but nonetheless continues its structural decrease as we get deeper into the winter. Lastly, hydro reservoir generation saw a decrease, pushing it close to the lower end of the past 5-year range. In terms of fossil fuel generation, we saw that uptick in fossil gas power output, moving it closer to the past 5-year average. In terms of coal, we continue to see very weak coal power generation compared to previous years, with output remaining at the bottom of the range over the past 5 years. Lastly, looking at the guarantees of origin price evolution, we saw a slight uptick in the price level, particularly looking at the 2025 production year, with prices increasing noticeably versus the previous week. But overall, we continue to see a bearish price evolution, especially given the sharp decreases that we've seen over the last few weeks. In terms of cumulative renewable generation in AIB countries, we see output just slightly below last year's levels. And that has been primarily due to a worse hydropower output so far this year compared to last year. On the other hand, we've seen solar power generation at record highs, easing the drop in hydro, with wind power output improving and getting closer to the levels that we were seeing at the same time last year. That covers this week's market presentation. Thank you for joining.